Do you know the exact year your family will stop needing you financially? And what happens if your coverage ends before that? Most people have never been asked this question, yet it is the single most important question behind term life insurance. Life insurance is not about guessing when something might happen. It is about understanding how long your family depends on you and making sure protection lasts for every one of those years. When people ask about the best age to buy term life insurance, they often expect a complicated answer involving formulas or predictions. In reality, the answer is simple. The best age to buy term life insurance is the moment you become financially responsible for someone else. That responsibility can begin when you get married, buy a home, have children, support aging parents, or take on long-term debt. Term life insurance exists to protect income during these responsibility years. And the earlier you protect that income, the lower the cost and the greater the flexibility. This becomes very clear in illustration 1, best age to buy term life. In this illustration, the exact same $1 million 20-year level term policy is shown at different ages. When purchased at age 25, the cost is approximately $40 per month, or $480 per year. At age 35, the same policy costs about $65 per month, or $780 per year. At age 45, that same coverage jumps to roughly $145 per month, or $1,740 per year. Nothing about the policy changed. The coverage stayed at $1 million. The term length stayed at 20 years. The only thing that changed was age, which increased health risk and therefore increased price. This illustrates why waiting does not improve coverage. It only increases cost. One of the biggest misconceptions about term life insurance is that it is expensive. It is not. What is expensive is waiting. Insurance pricing is built around risk, and risk increases with age and health changes. Even minor medical conditions can impact premiums later. When you buy term life insurance early, you lock in both your health rating and your price for the entire term. The coverage remains constant, but the cost of delay compounds over time. This is why someone who buys a policy in their 20s or early 30s often pays a fraction of what someone in their 40s pays for identical protection. Waiting does not make insurance more useful or more powerful. It simply makes it more expensive and less flexible. Just as important as when you buy term life insurance is how long your term should last. This is where many people unknowingly create protection gaps. They choose a term length based on what feels affordable today instead of how long their family will actually need financial support. Term life insurance should never expire while financial responsibility still exists. This is explained step by step in illustration 2, picking the right term length. The first step is identifying your longest financial obligation. In the example shown, children are expected to become financially independent in about 18 years, while the mortgage payoff timeline is approximately 23 years. That means the longest financial need lasts about 23 years. The second step is choosing a term that covers that entire window. A 10-year term ends far too early and creates a protection gap. A 20-year term may still expire before the mortgage is paid off. A 30-year term covers the full obligation window with additional buffer, ensuring protection does not end prematurely. A 10-year term often looks attractive because it is cheaper up front, but 10 years passes quickly. If you still have a mortgage, children in school, or income your family depends on, the need for protection does not disappear simply because a policy ends. When a short term expires and coverage is still needed, replacing it later can be significantly more expensive, assuming coverage is still available. A 20-year term is often considered the most balanced option. It aligns with child dependency years, income replacement needs, and major financial responsibilities. For many families, those 20 years represent the most financially vulnerable period of life. A 30-year term provides the longest protection and is especially powerful when purchased early. It can cover an entire mortgage, a full working career, and the years during which children transition into independence. Choosing a longer term early often results in lower total cost over time, compared to buying shorter terms and replacing them later. The right term length is not determined by age alone. It is determined by responsibility duration. Ask yourself how many years your family would need financial support if your income disappeared. That number should dictate your term length. Protection should end when responsibility ends, not before. Understanding how much coverage is needed is just as important as understanding timing and duration. This is clearly illustrated in illustration 3, income replacement math. In this example, annual household expenses are broken down into real categories: housing and utilities at $30,000 per year, food and transportation at $18,000 per year, and insurance and childcare at $17,000 per year. These essential costs total $65,000 annually. When that annual need is multiplied by 20 years of support, the total income replacement requirement reaches $1,300,000. This math demonstrates that proper coverage is not based on income alone, but on maintaining a family's standard of living. Coverage can then be rounded to $1.25 million or $1.5 million based on debt, savings, and future goals. Another common mistake is choosing a term that is too short, which leads to higher costs later. This is demonstrated clearly in illustration 4, why short terms cost more. In this example, a 10-year term is purchased at age 30 for about $25 per month. 10 years later, at age 40, the individual still needs 20 more years of protection. Replacing that coverage now requires a new 20-year term costing about $90 per month. What changed was not the need for coverage. What changed was age. The lower locked-in rate from the 30s was lost. Risk increased, and cost increased as a result. This illustrates why longer terms purchased earlier often cost less overall than stacking shorter terms over time. Another reason buying early matters is insurability. And this is something many people underestimate. Most people assume they will always qualify for life insurance later because they feel healthy today. The problem is that health can change quietly and unexpectedly. Conditions like high blood pressure, elevated cholesterol, sleep apnea, diabetes, anxiety, or even a single abnormal test result can affect eligibility or significantly increase premiums. These changes do not require a major health event. They often develop gradually and without obvious symptoms. When you buy term life insurance early, you are not just locking in a price. You are locking in your health status at that moment in time. That means even if your health changes in the future, your coverage and premium remain the same for the entire term. Waiting assumes that your future health will cooperate with your plans, and that is not something anyone can control. Buying early preserves access to affordable coverage when it is easiest to qualify. It removes uncertainty from the equation and ensures that protection is based on intention rather than availability. In simple terms, buying early turns health into a non-issue for the years your family depends on you financially. The purpose of term life insurance is simple. It creates time to grieve without financial panic, time to adjust without rushed decisions, time to maintain stability when everything else feels uncertain. That time is created by two decisions: buying early enough and choosing a term long enough. If you buy too late, you pay more. If you choose a term that is too short, coverage can disappear while it is still needed. When both decisions are made intentionally, term life insurance functions exactly as it was designed to. So ask yourself again, do you know the exact year your family would stop needing you financially? And what happens if your coverage ends before that? That question is not meant to create fear. It is meant to create clarity. Most people have never mapped their financial responsibilities across time, yet those responsibilities exist whether they are acknowledged or not. When that question makes you pause, it means you are beginning to think intentionally about protection instead of assuming it will somehow work out on its own. Awareness is the first step toward preparation, and preparation is what turns uncertainty into stability. Understanding when to buy term life insurance and how long your coverage should last is not about overthinking the future. It is about matching protection to reality. When timing and term length are chosen correctly, term life insurance becomes a quiet foundation that supports your family through every stage that matters. If this helped bring clarity to those decisions, make sure to like this video, subscribe for more clear and practical financial education, and stay connected as we continue helping families build lasting protection, confidence, and peace of mind for the years that truly matter.